Bismillah ar-Rahman ar-Rahim. Welcome student to the final examination revision for Accounting 2 course. First we start with the curriculum required material for the final examination. Starting with question 1. Furniture sales company uses the perpetual inventory system and had the following transaction during May 2022. On May 1, sold merchandise on credit for 7,500 to customer Hani. Terms 310, net 30. The items sold had a cost of 6,900. So starting with transaction number 1, on May 1, we will record account receivable to Hani on debit side 7,500 and sales credit 7,500. This is the first part. So you write account receivable Hani debit for 7,500 and credit sales credit 7,500. This is the first part. The second part we will record the cost of goods sold. This is on perpetual inventory system. We had to record the cost of goods sold. So we will write cost of goods sold debit 6,900 and merchandise inventory, because it is under we are using perpetual inventory, we will write merchandise inventory credit 6,900. Then we go to next transaction. On May 4, purchased merchandise for cash 2,100. So we will record purchase with cash. So debit merchandise inventory 2,100 and credit, so the purchase was in cash, credit cash 2,100. On May 5, purchased merchandise for 4,600 on credit. So we'll have debit merchandise and credit accounts payable, because it was on purchased on credit. So debit merchandise inventory for 4,600 and credit account payable 4,600 on credit. Last one, received full amount due from customer Hani. Received full amount from customer Hani. So please, we will go back to May 1st. We had sold merchandise to Hani for 7,500. The terms says 310. So we will Hani will get 3% discount if he paid within 10 days. So the sales date was May 1st and we have received the payment on 9. So it's not more than 10 days. So Hani will get the discount, the 3%. So we record the cash minus discount. So first cash debit, also sales discount debit, and we will record account receivable for Hani, the full amount, which was 7,500. Now sales discount, we had to record how to calculate the discount. 7,500 multiply 3%. So Hani will get discount of 225, and cash will be 7,500 minus 225. So the net amount we will receive, which is for 7,275. So we have finished question 1. Now moving to question 2. Question 2, the following transactions were completed during June 2022 in Ahmed Trading Establishment. June 1st, purchase merchandise for 10,200 on account. So the purchase was on account from Adil Company. So we record under prepare the journal entries using periodic inventory system. Under periodic inventory system, we will record the purchase. So debit purchase 10,200 and credit account payable 10,200. On June 4, received a credit memorandum from Adil Company. So Adil retained the purchase, some of the purchased items. So we record purchase retain. So debit accounts payable 200, credit purchase retains 200. On June 5, sold merchandise on account to customer Salim for 25,000. We will record the sales on June 5, sold merchandise on account. So we'll have account receivable Salim, debit 25,000 and credit sales. On June 7, paid full amount due to Adil Company. So we have purchased merchandise from Adil on June 1st, and we retain some of it on June 4. Now we have to pay the remaining amount to Adil. So will be account payable debit 10,000 and credit cash 10,000. So how to calculate the remaining amount? We had a purchase of 10,200 minus purchase retain of 200. The remaining amount will be 10,000. On June 10, received 15,000 due from customer Salim. So we will record cash debit 15,000, credit account receivable Salim 15,000. On June 12, sold merchandise to customers 8,000 for cash. We have sales with cash, so we record debit cash 8,000, sales credit 8,000. So that's it for question 2. Now moving to question 3. Question 3, the following balances on December 31, 2021 for Auto Parts Company. We have credit sales of 420,000, accounts receivable of 70,000, and allowance for doubtful debts of 500, and we have credit balance. Required repair journal entries for the following transaction. Estimate allowance for doubtful debt is to be increased to 2% of accounts receivable. And on December 31, 2021, Talal establishment can't pay his balance of 250 was worthless. Auto Parts Company write off this amount receivable and uncollectible. On January 15, 2022, Auto Parts Company received 250 of Talal establishment, which wrote off on December 31, 2021. We will start by estimating the allowance for doubtful debt by 2% of account receivable. The first entry for recording bad debt, the entry will be debit bad debt expense, and credit allowance for doubtful accounts. So 2% of account receivable, and we have 5%, and we have 500 credit balance. So we will, in a bracket, we will calculate the estimation 770,000 account receivable multiply by 2%, which will be 1,400 less the balance of 500. Total will be 900. Also for the allowance for doubtful account. On December 31, Talal establishment can't pay his balance of 250 was worthless. Auto Parts Company write off his amount account receivable and was uncollectible. So the entry will be debit allowance for doubtful accounts of 250, credit account receivable 250. On January 15, 2020, Auto Parts Company received 250 of Talal establishment, which was wrote off on December 31. So we need to reopen the account. So the first entry, it will be on two steps. The first entry will be to reopen the account. It will be debit account receivable 250 and credit allowance for doubtful accounts 250. The last entry, we will record the receipt of cash. So debit cash 250 and credit account receivable 250. Now moving to question 4. Question 4 says Badr Company purchased a new machine for 19,000 on January 1st, 2019. The machine has an expected salvage value of 1,000 and is expected to be driven 50,000 miles over its estimated useful life of 5 years. Actual miles driven were 20,000 on 2019, 15,000 on 2020, 10,000 miles on 2021, and 5,000 on year 2022. Required find the depreciation and net book value for the 4 years by using the units of activity methods. So starting with depreciation cost per unit, how to calculate by the following steps. We need the cost. We have the cost of 19,000. This is the cost, and we have the salvage value of 1,000. The total miles will be, we will divide by total miles. We have here already calculated for us 50,000 miles. If we didn't have it, we need to add the miles for all years. So the steps will be 19,000 less the salvage value 1,000 divided by 50,000. It will equal 0.36 per the cost per unit. Now moving to the depreciation cost for the period. On the table we have to record the first is the book value for the at the beginning 19,000, and we will start by writing the number of units for each year. Starting with first year 2019, we have 20,000 units. So we have 20,000 units and 15,000 2020 and 10,000 and 5,000 on 2021. So we'll start by writing first year 20,000, second year 15,000 miles, third year 10,000 miles, and last year 5,000 miles. The depreciation cost already we have calculated is 0.36. It will be fixed for all years. So 0.36. Now we need to multiply the depreciation cost per unit, the number of units, by depreciation cost per unit. So we will multiply So the answer will be 7,200 first year. Second year also the same process, 5,400, and third year 3,600, and last year we have 1,800. Okay, for the accumulated depreciation, first year we don't have before, so it will be the same as 7,200. Then on the second year we need to add the depreciation expense for the year with the accumulated for the previous year. So we need to add, so it will be 5,400 plus 7,200. It will be 12,600. Same process also. 3,000 plus 12,600, and we'll have 16,200. 18 plus 16,200 will be 18,000. Now for the book value. So for the book value we need to deduct the book value for the first year for all accumulated depreciation for each year separately. So 19,000 less 7,200. So here we'll write 19,000 less 7,200 will be 11,800. Next year 19,000 less 12,600 will be 6,400. Third year 19,000 less 16,200 will be 2,800, and last year 19,000 less 18 will be 1,000. Will be the same as the salvage value, which was 1,000. Question 5 says, on January 1st, 2019, Al-Madina company purchased equipment for 42,000. It has been depreciated using the straight line method based on estimated salvage value of 2,000 and an estimated useful life of 5 years. It has accumulated depreciation of 24,000 on December 31, 2021. Prepare the journal entries to record the sales of the equipment in these independent situations. First situation, sold the equipment for 18,000 for cash on December 31, 2021. So we will record cash debit of 18,000 and debit accumulated depreciation of 24,000 and credit equipment of 42,000. The second situation, sold the equipment for 20,000. The first case, we don't have no gain, no loss. Second case, we will get extra 2,000 because we sold it for 20,000. So we record cash debit 20,000, debit accumulated, depreciation 24,000, and credit equipment 42,000. So we need to match both totals. Here we have 44,000 because we add 20 plus 24,000, and here we have 42,000. So the remaining amount is gain of 2,000 will be on credit. So credit gain on disposal. Now moving to question 5. Question 5, on January 1st, 2019, Al-Madina Company purchased equipment for 42,000 of equipment. Now moving to question 6. The following balances was extracted from the books of Noor establishment on December 31. We have the following accounts. We have cash, sales, purchases, sales discount, purchase returns, beginning inventory, ending inventory, carriage and salaries expense, electricity expense, rent expense, and interest expense, and income tax of 10,000. Required prepare the multiple income statement, the multiple step for the year ended 31 December 2021. So here we will start preparing the income statement, starting with sales. We will get the information from the question. So we have sales of 107. We will use the columns for totals, starting from here. 107,000 sales less sales discount. So we have sales discount of 2,000, also from the question, which will equal net sales. $107,000 less 2,000 will equal $105,000. This is the first part for the net sales. Next part will be cost of goods sold. This is the title. We'll start by beginning inventory. We have 3,200. We'll leave it on the side, and we will continue with purchases. We have purchases of 81,000 less purchase return. We have purchase returns of 6,000. So 81 minus 6,000 will give us net purchase of 75,000. will add carriage in to calculate the cost of purchase. So add carriage in of 150 will equal cost of purchase. 75,000 plus 150 will equal 7,150. Move it here. So 75,150. Next step, we will add beginning and cost of purchase to calculate the cost of goods available for sale. Cost goods available for sale. 3,200 plus 75,150 will equal 78,350 cost of goods available for sale. Now we will deduct the ending inventory. So less ending inventory. We have ending inventory of 2,400, which will give us cost of goods sold. We'll move it here of 75,950. Now we can calculate the gross profit or loss, gross profit or gross loss. So net sales less cost of goods sold will give us gross profit of 29,050. Next part is operating expenses. This will be the title. We'll start by salaries expense 2,600. Then we'll add electricity expense 500 and rent expense of 300. The total will be, we'll write total operating expense. We'll add the expenses will be 3,400. Now to calculate the income from operations, we will deduct the operating expense from gross profit. So 29,050 minus 3,400 will give us the income from operations, which will equal 25,650. Now we will record other expenses and losses. We have interest expense, so this will be less 25,650 less 250 will give us the income before tax. So we'll deduct 25,650 less 250 will equal 25,400, and now we have to write the income tax of 10%. So we have 10, we have to multiply it by 25,400 will give us, we have interest expense of 250, 2540. So we'll deduct 25,400 minus 2540 will equal 22,860. This will be our net income. So we reach the end of this revision. I hope you will benefit from this revision for the final examination. Best of luck, and thank you for listening.